Hello everyone, good evening. Right now, it is February 9th, 2026, and today we are officially entering a brand new trading week. So for this week, when we look at the indices, things are actually playing out exactly as we projected last week. The overall channel structure is still very intact. After technology stocks went through a round of panic selling, that fear has now been gradually absorbed by the market. And once that panic was digested, what we saw was a sharp rebound, which is exactly what we described last week as a discounted pricing opportunity. That rebound has been very strong. Today, all three major indices closed higher together. Now let's first take a look at what actually happened. We mentioned earlier that last week's three-day decline was mainly driven by developments in AI software. Companies like Anthropic released new tools such as Claude Cowork, and that triggered concerns across the market about whether SaaS software companies as a whole can still survive in the long run, right? So that kind of fear spread very quickly throughout the entire market. At the same time, against the backdrop of big tech companies continuing to increase their capital expenditures, investors also started worrying about future earnings reports. On top of that, last week's ADP data came in below expectations. All of these factors combined to create what we described as a discounted market scenario. And visually, that kind of move can look very scary. So let's start by looking at this first. Let's begin with the S&P 500. The S&P in comparison has actually been moving in a relatively healthy way, mainly because it is not an index that is completely dominated by technology stocks. Overall, its structure looks much healthier. After forming an upward channel, it moved into a period of consolidation at high levels, and throughout this process, it has consistently followed the 120-day moving average upward, without breaking below the rising channel structure. This is a very clean and very well-behaved chart. Under this kind of condition, generally speaking, this type of market will continue to move up, then pull back, then move up again. When an ascending channel remains very complete and the high-level consolidation is smooth like this, typically it will go through 2 to 3 more rounds of consolidation. But the key point is that the highs keep getting higher and the lows also keep getting higher. That's the most reasonable and healthiest way for the market to move upward. However, when we look at the Nasdaq today, the situation is actually not quite as healthy. The Nasdaq is the index that is most sensitive to technology stocks. In this recent pullback, it actually came down and tested the 120-day moving average. So is that a good thing or a bad thing? It is absolutely a good thing. Why do I say that? Although the 120-day moving average is technically considered a medium-term bull-bear dividing line, when the market quickly tests it at high levels and then quickly digests that move, in most cases, it will go on to make new highs. Generally speaking, it will make new highs again. What this tells us is that the cost basis in this area has already been absorbed. In other words, within the 120-day time cycle, all investors are now above water. And when we say above water, we mean they are in a profitable position. And everyone knows this. Being in a profitable state is extremely important for investor confidence, all right? Generally speaking, after the market has digested the pressure from the 120-day moving average, it will usually go back to test the previous highs. After 1 or 2 attempts at testing those highs, it will then move upward. And when it moves, it tends to move very, very high. This is our view on the indices today, and this is our outlook for what comes next. This kind of high-level consolidation is extremely clean. In other words, investors can be relatively confident in making one key judgment. The so-called bubble in technology stocks, including this round of the AI rally and even the semiconductor sector, is still far from the point of being punctured. If you really take a look at companies like Nvidia, Qualcomm, Broadcom, and Google, and examine their price-to-earnings ratios, you'll find that they are still nowhere near bubble territory. And on top of that, after the latest U.S. consumer confidence data came out, ahead of the next non-farm payrolls report scheduled for February 11th, consumer confidence received a very strong boost. Of course, that boost works in both directions, and it came after the Dow Jones Industrial Average firmly held above the 50,000 level. We mentioned last week that this area was a very important platform, right? And then the very next day, the index broke above 50,000. Our judgment at the time was that this platform was almost certain to break to the upside. And once that breakout happened, the market would continue moving higher, so much so that it might not even come back to retest this platform. Instead, it would likely pull back only to a much smaller, shorter-term platform. In fact, we may not even be able to clearly identify where that new platform is yet. That means the new base hasn't fully formed, which also means overall valuations still have room to rise, and prices as a whole are still moving higher. That is our core assessment. The Dow Jones breaking above its historical high has also played a major role in pushing consumer confidence sharply higher. There's another development today that is also very important. It's not exactly news in the traditional sense, more like a topic that the tech industry has been paying very close attention to recently, and that topic is Intel. As everyone knows, Intel has long been considered the king of the semiconductor industry, right? Originally, it dominated the market with its central processing units, but after graphics accelerators came into the picture, the throne gradually changed hands, and it ended up in Nvidia's hands. That said, Intel's chip R&D capabilities are, without question, among the strongest in the world. This is a company that has been deeply invested in semiconductor research and development for many, many years. Intel now has a new manufacturing process called 18A This process is no longer measured in traditional nanometer terms. It represents a more advanced generation of chip manufacturing technology. However, the yield rate of this process has long been criticized by the market. Everyone knows that taking a chip from design to tape out is an extremely long process, and the yield rate is, in many ways, not much different from gambling. You could easily invest several $billion or even tens of billions and still end up with yields so low that the chip simply cannot be commercialized. This time, however, Intel's new manufacturing process has delivered a yield rate that is far above market expectations. And while this may sound like it's just about one company, in reality, it could represent a major inflection point for the entire global semiconductor industry. If this process truly works, then it marks a very clear turning point. Why do I say that? Because right now, the most advanced GPU wafer manufacturing processes in the world are controlled by TSMC. And as we all know, TSMC is fundamentally an Eastern-based company. For a long time, no US-based company has been able to truly compete with TSMC at the highest level, whether it's Broadcom, Qualcomm, or even IBM. No one has really been able to stand head-to-head. Now Intel has stepped forward and said, we have a more advanced process. And not only that, the yield rate has significantly exceeded expectations. This could very well echo that phrase from Trump, make America great again, or MAGA. It could represent a turning point for the US semiconductor industry, or even a moment where it starts to overtake competitors. So from a broader market perspective, this development carries significant weight. And from an industry structure perspective, it has very important implications for the entire semiconductor landscape. When we look at Intel on the weekly chart, the stock actually shows investment value. It has gone through two very deep pullbacks, what we typically refer to as a double bottom. These two bottoms are extremely important, and they were formed over a very long period of consolidation. This is a very solid base, and we can even call it a valuation bottom. If we look at the weekly footprint chart, we can see that Intel's consolidation has been very complete. And if we shift from the weekly time frame to the daily chart, we can see that the valuation center, the entire valuation core, has been steadily moving higher, continuously moving higher. So today, if you are looking to select new stocks within the semiconductor sector, my suggestion is that Intel should be added to your watch list. The second piece of news today that is also quite important is related to Japan. Yesterday, Sanae Takaichi's party achieved a major victory in the parliamentary elections, and she has now become Japan's new prime minister. Her new government is strongly supportive of the development of high-tech industries and the semiconductor sector. This has helped boost confidence across global markets. And why is this so important? Because historically, Japan has been primarily manufacturing driven, right? Manufacturing has always been its strength. But in areas like software, especially cutting-edge, advanced software, Japan has not really been at the global frontier. This time, however, the Takaichi administration is fully committed to aggressively supporting the development of the technology sector. And that sends a very important signal to global equity markets. This is also one of the reasons behind today's market strength. Next, let's talk about another name that most people here probably already hold, but I still want to mention it again because I personally have been holding it for many years, and that stock is Tesla. I've owned Tesla for many years, but today I still want to talk about it again. There was another piece of news today. Tesla's full self-driving system, FSD, has officially begun operating at its training center in China. As everyone knows, FSD has not been fully rolled out on the Chinese mainland. Chinese Tesla owners have not been able to enjoy the benefits of full autonomous navigation. Now, on the surface, FSD may look like just a navigation system, but in reality, it is an AI data training engine. The fact that Tesla's local training center in mainland China has started operating means that in terms of AI's interaction with the physical world, and we all know that the future of AI is about understanding the physical world, this represents another major step forward. So whether we're talking about Tesla itself or Elon Musk's XAI ecosystem, this is a milestone event. Of course, from the launch of a training center to full commercial deployment is still a very long process. But from an investment perspective, this is a critical point where we can clearly see the story continuing. The narrative is still moving forward. So in my personal view, Tesla remains one of the safest investments in the US equity market today. One of the safest. Now that we've said that, let's briefly talk about the technical side. And on the technicals, we're only going to look at the daily chart. Because for a stock like Tesla, short-term trading doesn't really make much sense. This is fundamentally a daily chart hold. At minimum, you're thinking in months or years. What we can see is that during last week's market pullback, Tesla also followed the market and went through a correction. And near the previous high, around the December 19th, 2024 high, the stock temporarily found support. But my personal view is this: Tesla is a high-growth company with many narratives driving it forward. And for companies with very strong narratives, you shouldn't over-focus on technicals. As long as there isn't a continuous, explosive vertical rally, these types of companies are still worth participating in and worth including in your portfolio. So, in my opinion, Tesla remains one of the most worthwhile individual stocks to invest in. Back in 2014, Tesla also experienced a situation similar to the 2021 peak, followed by a deep correction. But eventually, it returned to those highs. What does that tell us? It tells us that all the panic selling and all the profit-taking pressure had already been fully absorbed. So for this company, investors can continue to pay attention. If the stock offers another discount near the highs, it is still something you can continue to buy. And that's today's discussion on Tesla. In addition, today we'd like to share one more individual stock with everyone. Consider it as a benefit. I believe most of you already hold Tesla, so let me introduce another name, and that is Micron. We're sharing 3 stocks in total. You can add all of them to your watch list. Micron, or Micron Technology, ticker MU, operates in the memory space, specifically DRAM. In this segment, Micron is essentially an oligopoly player. Together with SK Hynix, they form a 2-player dominant structure. But why do we believe Micron still has significant upside potential? If we look at the weekly chart, it does appear that the stock has already risen quite a lot. Logically speaking, this is where people might start to become cautious. But personally, I'm not suggesting that you chase it aggressively at these levels. Instead, during this phase, the more reasonable approach is to accumulate gradually, either on a weekly basis or on a monthly basis. Let me explain the reasoning. If we zoom in, whether it's the hourly, 4-hour, or simply the daily time frame, let's just stick with the daily chart. From the daily perspective, Micron has already started a corrective phase. And typically, this kind of pullback is not finished right away. These adjustments usually take time. We often see a move from here down to here, then a rebound, and potentially another leg lower as it continues to follow the broader market rhythm. That said, I want to be very clear. This is only one possible scenario, just a possibility. But personally, I don't think you need to wait for the stock to pull back all the way to a specific level before buying, because there's also the possibility that it simply doesn't pull back that deeply. It could just stabilize and then take off again. That's something we cannot predict with certainty. If it does pull back to that deeper level, of course that would be a great opportunity, assuming you actually have the courage to step in when it happens. That's easier said than done. From my perspective, at current prices, it already makes sense to start building a position gradually. Let me give you 2 key data points. First, Micron's current price to earnings ratio is relatively high, around 35 to 36 times, but the earnings growth is extremely strong. Based on forward EPS estimates, if we calculate using next year's earnings, Micron's forward PE at the current price could drop to around 10 times. And in the semiconductor industry, a 10x PE implies massive upside potential. Typically, semiconductors trade closer to 30x, right? On top of that, consider the broader AI trend. Whether it's servers, data centers, or eventually consumer devices, AI phones are already being discussed as a real concept. All of these endpoints require enormous amounts of memory. DRAM demand will be huge, potentially on the same level as demand for chips and GPUs. You can build a computer without a standalone display. You can integrate graphics, sound, even parts of the motherboard. But memory is non-negotiable. High-quality DRAM must come from specialized high-end manufacturers. This makes Micron's earnings visibility very real and very tangible. Technically speaking, the price action is also very clean. The stock has already gone through a pullback, and that pullback was fairly deep, roughly around 5%. Ideally, we would like to see it pull back into the 2006-2008 zone. But again, if you remain confident in the semiconductor sector, I believe it makes sense to begin accumulating slowly starting now. Now let's return to today's main theme, the indices. Among the indices, our primary focus remains on the Nasdaq. Why the Nasdaq? Because the Dow Jones mainly reflects traditional industries, manufacturing, industrials, old economy sectors. Under current inflation expectations, it's natural for the Dow to perform well, but the stocks that truly drive returns, the ones that really make money, are still concentrated in the Nasdaq. So that's where our attention needs to be. Now, looking at the Nasdaq, there is a bit of perceived risk. Some people are starting to worry about a potential rounding top. Visually, it does look like it could be forming a large arc and rolling over. But personally, I think that in this kind of process, when you look at the big picture, when you look at the macro, the weekly chart, the daily chart, it kind of looks like this, right? When you look at the weekly and the daily, it sort of looks like this big rounded structure, like a large rounding top, starting to form, starting to roll over. You do see that. That picture is there. But if you look at it from the macro level, yes, that's what it looks like. However, if you break it down further, if you zoom in and we now switch back to the daily chart, you'll notice that every single pullback so far has been absorbed very quickly. Last week, we mentioned that during a pullback, price would likely test the lower boundary of the channel, right? We can't draw perfectly here, but visually you can roughly see where that lower boundary is. You can even just use the 120-day moving average as a proxy for that lower edge. And each time, price reclaims it very quickly. In this kind of situation, generally speaking, the market is not something you can only trade from the right side. When we look at it now, whether it's market sentiment, capital flows, or the valuations of related stocks, everything is still within a safe and healthy range. So at this point, our conclusion is very clear. Our view remains bullish and our positioning remains on the long side. All right, that's it for today's market breakdown. Tomorrow, we'll continue by dissecting more individual stocks. If you have questions or you want to know more about the stocks you own now, you can comment below or join my group to discuss more. Don't forget to like and subscribe. See you tomorrow.